Hey there, and welcome back to the Deep Dive. Today, we are going to be doing a deep dive into the world of investing and specifically value investing
Oh, yeah.
with The Intelligent Investor
It's a classic.
by Benjamin Graham.
It really is.
So much wisdom in this book, and it's pretty amazing how relevant it still is
I
today,
know, it's incredible.
decades after it was written.
Yeah, it's like he had a crystal ball or something. He was predicting the pitfalls that trip up investors even now.
Yeah, and people are still making the same mistakes
Over and over.
over and over again.
It's a human nature.
All right, so let's unpack this a little bit, this intelligent investor approach. What is the big idea here? What's the core concept that we need to understand?
Well, the core concept is that successful investing is not about, you know, chasing hot stocks or trying to time the market.
Okay.
It's about buying valuable businesses at reasonable prices
Right.
and holding them for the long term.
Okay.
That's the key takeaway.
So it's not about like day trading or gambling
No.
on short-term price movements.
It's about building wealth gradually over time
Okay.
by owning a piece of these fantastic businesses.
Okay. So that's the goal, but how do we find these valuable businesses and more importantly, I think at the right price?
Right.
That's where it gets tricky.
Yeah, that's the art of it, right?
Yeah.
So one of the most powerful concepts that Graham introduces is this idea of Mr. Market. Okay? So picture this. You've got this fellow, Mr. Market.
Right.
He's kind of emotional.
Okay.
And he shows up at your door every single day offering to buy or sell you stocks.
Okay.
And some days he's euphoric.
Right.
He's like, I'll pay anything for these stocks.
Mhm.
And then other days he's depressed and he's practically giving them away.
Wow.
So
Okay.
you can-
So the market is basically driven by mood swings.
It can be.
That's a little unsettling, isn't it?
Well, it can be unsettling if you let yourself get caught up in it.
Right.
Right. The intelligent investor understands that Mr. Market's offers are often irrational.
Okay.
They're driven by fear and greed.
Right.
And so the key is to not be swayed by his emotions, but to learn to recognize when he's offering you a true bargain.
Okay, so how do we tell when Mr. Market is being irrationally pessimistic?
Right.
Like, how do we spot a bargain? What are the signs?
Well, that's where the margin of safety comes in.
Okay.
And this is one of the most important principles from Graham.
Right.
It basically means buying a stock for significantly less than its intrinsic value.
Right.
What is intrinsic value? It's the true worth of the business based on its assets,
Right.
its earning power, all those fundamental factors.
Got it.
So you're buying it for less than it's actually worth.
Mm-hmm.
It's like having a buffer zone.
Okay.
It protects you if things don't go exactly as planned.
So it's not enough to just find a good company.
Right.
You need to buy at a price that limits your downside risk.
Exactly.
I'm trying to see how this all fits together.
All right.
But tell me, isn't it like incredibly time-consuming to analyze companies in this way?
Well, it can be.
Yeah.
And that's why Graham makes this distinction between two types of investors.
Okay.
He talks about the defensive investor and the enterprising investor.
I'm all ears. Tell me more. Which one am I?
Well, we'll have to figure that out. But the defensive investor prioritizes safety and simplicity.
Okay.
They're not looking to spend hours poring over financial statements.
Right.
Instead, they focus on building a diversified portfolio of high-quality stocks and bonds.
So things like index funds
Exactly.
and dollar cost averaging would kind of fit into that.
Exactly. Those are classic strategies for the defensive investor.
Got it.
It's about participating in the market's long-term growth without taking on excessive risk or effort.
And what about the enterprising investor? What sets them apart?
So the enterprising investor, they're willing to put in the time and effort
Okay.
to potentially achieve those higher returns.
Yeah.
They relish the challenge of researching individual companies, digging into their financials, and identifying undervalued opportunities.
So they're really rolling up their sleeves and getting their hands dirty
Yeah, the deep dive.
with the analysis.
Yeah, exactly.
That sounds tempting, but also a bit daunting.
It can be. It definitely requires more work.
Yeah.
But Graham provides a roadmap
Okay.
for those enterprising investors.
Okay.
He emphasizes the importance of analyzing those financial statements,
Mm-hmm.
understanding management quality, and assessing a company's competitive position.
He makes it sound like you're becoming like a financial detective.
You are.
Yeah.
You're putting on your Sherlock Holmes hat,
Yeah, that's really cool.
and you're going out there and you're investigating these businesses.
But hold on. Didn't Graham also warn against speculation?
Yeah.
Where do we draw the line between intelligent investing and just gambling on stocks?
Right. That's a crucial distinction because speculation, in Graham's view, is driven by trying to predict those short-term price movements,
Okay.
often based on rumors or emotions or, tips you heard from somebody.
Like scrolling through social media for hot stock tips?
Exact. That's a classic example of speculation.
Got it.
The intelligent investor, on the other hand, is focused on the fundamentals of the business.
Okay.
They're looking for companies with solid earnings, strong balance sheets, and competent management teams.
Mm-hmm.
They're not swayed by the latest fads or market hype.
That makes a lot of sense.
Right.
Yeah. So we've talked about Mr. Market, the margin of safety,
Mm-hmm.
the difference between defensive and enterprising investors.
Right.
This is already making me rethink my whole approach
Me
to
too.
investing. But I'm curious, what did Graham have to say about those trendy growth stocks?
Oh, yeah.
Everyone's always talking
Like
about
everybody loves growth stocks.
them. Weren't those his thing?
Well, actually, Graham was quite skeptical of growth stocks,
Right.
especially those with sky-high price-to-earnings ratios,
Okay.
because he saw them as vulnerable to those sharp declines,
Okay.
often driven by unrealistic expectations.
But don't companies need to grow to be successful?
Of course they do.
So I'm a little bit confused here.
Yeah, so growth is important, but Graham believed that investors often overpay for future growth potential.
Okay.
So he argued that a company's stock price should reflect its current earnings power and assets,
Right.
not speculation about what might happen years down the road.
So a company that has really amazing growth prospects could still be a bad investment
Right,
if its stock price is already reflecting that potential.
exactly. You're paying too much
Okay.
for that future growth.
Got it.
That hasn't materialized yet.
So it's almost like the market is like this popularity contest.
It is a popularity contest.
And sometimes the most popular companies are the most overpriced ones.
That's a great analogy.
Yeah.
That's exactly right.
Interesting.
Graham often pointed to examples like IBM,
Mm-hmm.
Texas Instruments.
Yeah.
These were considered high-flying growth stocks in their day
Yeah, back in the day.
and initially delivered impressive returns.
Right.
But their prices eventually became unsustainable,
Okay.
leading to significant losses for investors who bought in at the peak.
So even the best growth stocks can be risky
Right.
if you pay too much.
That's right.
I'm starting to see why Graham really emphasized this margin of safety.
Yes,
It protects you from those inevitable market swings
exactly.
and those overblown expectations.
It's your buffer.
Yeah,
It's your cushion.
this is all starting to click for me now. So we've covered a lot of ground,
We have.
but I have one more question about growth stocks.
Mike?
What about IPOs?
Oh, yeah.
Those initial public offerings.
The allure of the IPO.
Yeah, they seem to hold the similar allure of quick riches.
Right. Everyone wants to get in on the ground floor.
What was Graham's take on those?
He was equally wary of initial public offerings
Okay.
because IPOs, they often entice investors with this promise of getting in early on the next big thing,
Right.
but they often lead to disappointment.
Why is that? Isn't it a good thing to get in on the ground floor of a promising company?
Sometimes it can be,
Yeah.
but Graham warned that IPO prices are often driven by hype and speculation,
Okay.
rather than a realistic assessment of the company's value.
So the fear of missing out can lead investors to make kind of irrational decisions.
Absolutely. FOMO is a powerful force in the market,
Yeah.
and it can lead people to make some really bad decisions.
Okay.
So Graham believed that the intelligent investor should approach IPOs with extreme caution,
Got it.
carefully analyzing the company's financials and business model before investing.
It sounds like you really need to do your homework,
You
no
do.
matter how tempting the IPO might
Do
seem.
your due diligence.
Yeah.
Don't get caught up in the hype.
All right, so we've talked about IPOs, but
Mm.
honestly, analyzing financial statements can be pretty intimidating
It can be.
for the average investor.
Yeah, it's a lot of numbers.
Where do we even begin?
Well, Graham emphasized the importance of understanding a company's profitability,
Okay.
its financial health, and its ability to generate cash flow. He also pointed to specific red flags to watch out for.
Okay. I like that. Give me some red flags.
Things like excessive debt recurring, non-recurring costs,
What?
and confusing or opaque financial reporting.
Okay, so let's break those down.
Yeah.
What kind of debt levels should raise a red flag for us?
Well, excessive debt
Yeah.
can put a strain on a company's finances,
Right.
making it vulnerable to economic downturns or unexpected events.
Got it.
And then those non-recurring costs.
What are those?
Those are expenses that companies try to exclude from their earnings calculations.
Oh, so it makes their profits look better than they actually are.
Exactly. They're trying to sweep some of those expenses under the rug.
That's sneaky.
Yeah, and Graham warned investors to be wary of companies that consistently report these types of charges
Okay.
because it could indicate deeper problems with their business model or accounting practices.
So it sounds like you really need to be a detective to uncover these issues.
You got to dig a little deeper.
Yeah.
You can't just take the numbers at face value.
Right. You got to question those assumptions. Look for the inconsistencies.
Exactly.
This is really eye-opening.
Right.
Okay. So we've learned about Mr. Market, the margin of safety, the
Yes.
different types of investors,
Mm-hmm.
and the dangers of overpaying for growth stocks and IPOs.
Right.
We've even touched on the importance of analyzing financial statements.
Mm-hmm.
It's amazing how much ground we've covered already.
It is. It's a lot, but it's important stuff.
It is.
Right.
But before we move on, I got to ask, what was Graham's take on stock splits?
Oh, yeah, stock splits.
Do those actually benefit investors?
Well, Graham saw stock splits as largely cosmetic maneuvers
Okay.
that don't actually increase the value of a company.
Okay.
So they're more about psychology and perception than actual substance.
But don't they make the stock more affordable for smaller investors?
Well, that's the perception,
Yeah.
right?
It seems like a good thing.
It seems like a good thing, but it's kind of misleading,
Okay.
right? Imagine you have a pizza. If you cut that pizza into more slices,
Yeah.
you still have the same amount of pizza,
Right.
you just have smaller pieces.
Okay.
So it's the same with a stock split. You might have more shares, but each share represents a smaller ownership stake in the company.
So it's like a marketing tactic to make the stock seem more appealing.
That's a good way to put it.
Okay.
Graham believed that stock splits could be used to manipulate investor behavior,
Yeah.
creating this illusion of value
Right.
without any real substance.
Got it.
He urged investors to focus on those underlying financials of the business,
Right.
not on superficial stock price movements.
This is making me rethink everything I thought I knew about investing.
That's good. That means you're learning.
It seems like the intelligent investor needs to be a master of psychology
They do.
as much as a master of finance.
Absolutely.
Yeah.
Understanding human behavior,
Yeah.
both your own and that of the market,
Right.
is crucial for making those sound investment decisions.
That's why Graham's principles are still so relevant today. Even in a world that's vastly different
Yes.
from the one he wrote about.
Human nature doesn't change.
This has been an incredible deep dive so far.
It has been.
I'm already feeling much more informed
Good.
and empowered as an investor.
That's what we want.
What's next on our journey through The Intelligent Investor?
Well, in part 2, we're going to explore some of the more nuanced aspects of Graham's philosophy,
Okay.
including the role of market psychology
Okay.
and the importance of diversification.
Can't wait. Stay tuned, everybody.
It's going to be good. Welcome back to our deep dive into The Intelligent Investor. We've been exploring the foundations of Graham's approach, and now it's time to see how those principles actually apply in the real world.
You know, it's one thing to understand the concepts in theory, but it's another thing entirely to actually put them into practice.
Right.
What are some of the common mistakes that investors make, and how can Graham's wisdom help us avoid those pitfalls?
One of the biggest traps I think that investors fall into is letting emotions drive their decisions.
Oh.
Fear and greed can lead to impulsive buying and selling, often at the worst possible times.
Oh, I've been there.
We've all been there.
It's so easy to get caught up in the hype or the panic when everyone else is either buying or selling.
Exactly. You see the market plunging, and you're like, oh my God, I got to get out.
Right.
Or you see it skyrocketing, and you're like, I'm missing out. I got to get in.
Right. Everybody's getting rich but me.
Exactly. And that's when you're most likely to make a mistake.
Yeah.
So Graham really emphasized the importance of having a sound investment philosophy
Okay.
and sticking to it regardless of those market fluctuations.
So you got to have a plan
You got to have a plan.
and stick to it,
Stick to it.
no matter what's happening.
Remember Mr. Market. He's always trying to tempt us with his emotional swings.
Right.
But the intelligent investor sees through those antics.
So it's about staying rational even when the market is going haywire.
Right.
But how do we actually do that?
Right.
It's easier said than done.
It is easier said than done, but one helpful technique, I think, is to create a written investment plan.
Okay.
Outline your goals, your risk tolerance, your investment strategy.
Write it down.
Write it down because that can serve as an anchor,
Okay.
reminding you of your long-term objectives when the market gets turbulent.
So it's like having a roadmap to guide you through the wilderness of the market.
I love that analogy.
Yeah.
That's a great way to put it.
Keep you on the right path.
Keep you on the right path, exactly.
So another common mistake, I think, is just blindly following the crowd
Oh, yeah.
or listening to those so-called experts
The gurus.
who claim to have a crystal ball.
Right. They're always on TV.
Yeah.
Telling you what's going to happen next.
So don't believe everything you hear on those financial news channels.
Be skeptical.
Okay.
Right. Question everything.
Yeah.
Remember, Graham believed that the market is often irrational in the short term.
Right.
These talking heads might sound convincing, but they don't have any special insight into the future.
No one can predict the future.
No one can predict the future, so
Right.
take it all with a grain of salt.
This reminds me of another point that Graham made, the importance of thinking for yourself.
Yes.
It's so tempting to just follow the herd, but that can lead you astray.
It can get you into trouble.
Yeah.
So don't outsource your financial decisions to others.
Okay.
Take responsibility
Right.
for your own investments.
Do your own research.
Do your own research.
And learn to evaluate those opportunities based on your own judgment.
Exactly. Become your own financial detective.
There we go again.
Put on that Sherlock Holmes hat.
Yeah, that's a great analogy.
Go out there and investigate.
Don't blindly trust what other people are saying.
Exactly.
All right, another mistake I think investors often make is focusing too much on short-term performance.
Oh, yeah.
They get so caught up in those daily ups and downs of the market,
Right. Checking their portfolio every 5 minutes.
losing sight of their long-term goals.
It's like watching a pot of water boil.
Right.
You know, if you keep looking at it, it's never going to boil.
But isn't it important to track how our investments are doing? I
Yeah.
mean, we need to know if we're on the right track or not.
Of course, you need to monitor your portfolio, but don't obsess over those daily price movements.
Okay.
Remember, true investing is about owning a piece of a business
Right.
and participate in its long-term growth.
Long-term.
Those short-term fluctuations are just noise.
So we should be more like marathon runners
Yes.
than sprinters.
That's a great analogy.
It's not a quick race.
It's a long game.
Yeah.
Patience and discipline
Yeah.
are essential for long-term success in the market.
Okay, this is all making a lot of sense. But let's get specific. How do we actually apply Graham's principles to select an individual stocks? I'm ready to put on that detective hat.
All right, let's do it.
Yeah.
So first, remember Graham's emphasis on value.
Okay.
Look for companies that are trading for less than their intrinsic worth.
Okay.
Use metrics like price-to-earnings ratios,
Hmm.
price-to-book ratios, dividend yields to assess their valuation.
So it's like finding hidden gems
Exactly.
in the bargain bin.
Bargain hunt.
Companies that are kind of out of favor,
Right.
but still have really solid fundamentals.
Exactly. That's what Graham was a master of.
So look for a company that might have like a temporary setback, but has a long history of profitability
Right.
and a strong competitive position.
They've got a good track record, but maybe they're just going through a rough patch.
Are there any specific industries or sectors that tend to offer more value opportunities, or does it kind of change over time?
It definitely varies over time, but Graham often found value in industries that were considered kind of boring or out of fashion.
Okay.
Think of companies that provide essential goods or services,
Right.
things that people always need no matter what the economy is doing.
So not necessarily the flashy tech companies that everyone's always chasing.
Sometimes this can be great investments.
Yeah.
But you got to be extra careful
Okay.
with their valuations.
So you're saying like the fundamentals
Fundamentals are key.
are even more important than just the excitement around a particular company or industry.
Exactly. Remember, Graham's approach is about finding that value that's hiding in plain sight,
Right.
not chasing the latest trends.
Okay, got it. So we've got valuation.
Mm-hmm.
What else should we consider when we're analyzing a company? What would Graham tell us to look for?
He would say to focus on the quality of the business itself,
Okay.
understand its business model,
Mm-hmm.
its competitive advantages, and the strength of its management team.
Okay.
Look for companies with enduring brands and a history of generating consistent profits.
So it's not just about crunching numbers.
Right.
It's about understanding the qualitative aspects of a business,
Exactly.
the things that can't be captured in a spreadsheet.
It's the story behind the numbers.
Right.
That's what you got to understand.
Okay, so read the company's annual reports,
Yes.
their 10K filings,
Absolutely.
industry publications.
All of that.
Get a sense of their strengths and weaknesses.
Do your homework.
Pay attention to how management communicates with shareholders.
Very important.
Are they transparent? Are they accountable?
Right.
Do they have a long-term vision for the business?
Those are all great questions to ask.
It sounds like you really need to do your homework before investing in a company.
You do.
It's not a decision to take lightly.
This is your money.
Yeah.
This is your future. You want to make sure you're making informed decisions.
Mm-hmm. Okay. Any other tips for evaluating that management team? What qualities should we be looking for?
Pay attention to their track record.
Okay.
Have they created shareholder value over time?
Okay.
Are they investing for the long term, or are they focused on those short-term gains?
Right. Are they aligned with the interests of the shareholders?
Exactly.
Those are all great questions to ask.
Right.
So we've covered valuation, business model, management team. Anything else we should consider before pulling the trigger on an investment?
I think Graham would remind us to always remember his emphasis on financial strength.
Okay.
Look for companies with low debt levels,
Okay.
ample cash flow, and a history of conservative financial management.
So it's about finding companies that can kind of weather the economic storms
Right.
and continue to grow even in challenging times.
Exactly. A strong balance sheet provides that margin of safety,
Right.
protecting your investment from unexpected shocks.
So avoid those companies that are highly leveraged or have a history of financial instability.
Exactly. Stay away from those.
Okay, this has been incredibly helpful. Feeling much more confident about approaching the market with that intelligent investor mindset. It's like you've given me a whole new set of tools to use.
That's the goal.
Yeah.
We want you to be empowered.
This makes me think about how Graham defined the intelligent investor.
Right.
It's not about being a genius
Right.
or having insider information.
It's about having the right temperament
Yes.
and approach.
You've hit the nail on the head.
The intelligent investor is patient,
Right.
disciplined, and willing to learn.
Mm-hmm.
They're not swayed by that market noise
Okay.
or emotional impulses.
Right.
They make rational decisions based on that thorough analysis.
It's about being a student of the market
Yes,
and a master of your own emotions.
that's a powerful combination.
Yeah, I like that.
Right.
Yeah.
And remember, even the most intelligent investors make mistakes.
Oh, yeah.
We all do.
Everyone makes mistakes.
The key is to learn from those mistakes and continue to refine your approach over time.
Welcome back to the deep dive. We've been on quite a journey with the intelligent investor,
It really has been.
exploring Benjamin Graham's timeless wisdom.
Timeless, it really is.
It's amazing how relevant his ideas remain, even in today's fast-paced market.
I think it's because he really understood human nature.
Yeah.
He understood the emotions that drive us.
Right, and the emotions that can lead us astray.
Absolutely.
You know, speaking of emotions, we've talked about Mr. Market and his mood swings. But how does this understanding of market psychology actually help us make better investment decisions?
Well, I think by recognizing that the market is often irrational,
Right.
driven by those emotions, fear and greed,
Right.
we can detach ourselves from those swings.
So we don't get swept up
We don't get swept up.
in the frenzy.
We become more objective in our analysis.
Okay.
We avoid making impulsive decisions
Right.
based on what everyone else is doing.
So it's about having the courage to go against the herd,
Sometimes, yeah.
even when it feels uncomfortable.
Even when it feels really uncomfortable.
Yeah, that's tough.
It is tough.
But that's what separates, I guess, the intelligent investor from the rest of the pack.
Exactly. Remember, the intelligent investor thinks independently.
Okay.
They rely on their own research, their own judgment, not the opinions of the crowd.
They do their homework?
They do their homework, they see opportunity where others see fear, and they remain disciplined when others are getting swept up in euphoria.
This reminds me of that famous Warren Buffett quote.
Oh, yeah.
Be fearful when others are greedy and greedy when others are fearful.
That's a classic.
It's all about capitalizing on the market's irrationality
Right.
rather than being a victim of it.
Absolutely.
Graham believed that those market fluctuations
Yeah.
can create incredible opportunities
Okay.
for the astute investor.
For those who are prepared.
When prices are irrationally high,
Mm-hmm.
it's a time to be cautious,
Yes,
selective.
absolutely.
But when prices are irrationally low, that's when the real bargains emerge.
That's when you want to be greedy.
Right.
Yeah.
But how do we know
Right.
when the market is being irrational?
Oh.
It's not always easy to tell.
It's not easy to tell.
Yeah.
There's no foolproof method.
Right.
But Graham emphasized the importance of focusing on the fundamentals
Okay.
of the businesses.
So if a company's earnings are strong,
Right.
its balance sheet is healthy, and its management team is competent,
Mm-hmm.
then those short-term market fluctuations shouldn't deter us
Shouldn't scare you away.
from investing.
Well, that's right.
So it's about having conviction in our analysis
Conviction. Yes.
and not being swayed by those market mood swings.
It's easier said than done.
Easier said than done. I know, but
But that's the goal.
that's the ideal.
That's what we strive for.
Right. The intelligent investor has done their homework.
Yes.
They understand the true value of the businesses they own.
Right.
They're not easily shaken.
By that short-term volatility.
This brings up another important point that Graham really emphasized:
Yeah.
diversification.
Yes, diversification is key.
Why is that so crucial?
Well, it's about spreading your risk
Okay.
across different assets and industries.
Right.
It's a way to protect yourself from the inevitable ups and downs of the market.
Because no matter how skilled an investor you are,
You can't predict the future.
you can't predict the future.
No one can.
Right.
So you don't want to put all your eggs in one basket.
Don't put all your eggs in one basket, right?
Spread your bets.
Spread them out.
Reduce your exposure
Exactly.
to any single investment going sour.
Because anything can happen.
Anything can happen.
So by diversifying our portfolio,
Mm-hmm.
we reduce the impact of any single investment going wrong.
Exactly.
Even if one company experiences a setback,
Right.
the other holdings in our portfolio can help cushion the blow.
That's the idea.
Makes sense.
Yeah.
So how do we actually go about building a diversified portfolio? What are the key principles to keep in mind?
Well, first, consider your investment goals and your risk tolerance.
Okay.
A younger investor with a longer time horizon might allocate a larger portion of their portfolio to stocks,
Right.
whereas an older investor closer to retirement might prefer a more conservative approach
Okay.
with a higher allocation to bonds.
So it's a personalized approach
It
based on individual circumstances.
has to be tailored to your individual needs.
There's no one-size-fits-all solution.
Exactly.
Next, consider diversifying across different asset classes.
Mm-hmm.
This might include stocks, bonds, real estate commodities.
All of those.
Okay, and within each asset class, further diversify by investing in different industries and sectors.
Exactly.
So instead of just owning a bunch of tech stocks, for example,
Yeah.
we might also want to own some healthcare consumer staples, energy stocks.
Absolutely spread it around.
Okay,
Different industries have different risk profiles.
right.
So you want to make sure you're not overly exposed to any one sector.
You might also consider diversifying geographically,
Mm-hmm.
investing in both domestic and international markets.
That's another way to spread that risk.
This is all making me realize how much more there is to learn about investing.
It's a lifelong journey.
It's not just about picking stocks.
It's not just about picking stocks.
It's about building a well-rounded portfolio
Right.
that can withstand those market storms and generate those consistent returns
That's the goal.
over time.
Long-term success.
That's the beauty of it.
It is.
Investing is a lifelong journey of learning and discovery.
It really is.
The more we understand about markets and businesses and human psychology, the better equipped we'll be
Right.
to make those wise decisions.
That's right. Knowledge is power.
This has been an incredible deep dive
It did.
into the world of value investing.
It really has.
What's the one message that you'd like our listeners to take to heart?
I would say remember that investing is not a get-rich-quick scheme.
Right.
It's about building wealth steadily,
Mm-hmm.
sustainably over time.
Long game.
Long game, exactly. And by embracing Graham's principles of patience, discipline, and thorough analysis, you can achieve your financial goals and secure your financial future.
Well said. Thanks for joining us on this deep dive into the intelligent investor. We hope you've gained some valuable insights that will help you navigate the market with wisdom and confidence. Until next time, happy investing.